Hello, it's Kevin Thompson of Non-I Capital, and we understand that there's so much noise out there for you, the client, for you, the individual, and our job is to parse through that noise and make sure you can have a wonderful investing experience. So today we're going to give you guys three things to consider, and it'll allow us to remove everything else. The three most important things to consider as we head down in 2024 towards the election until the end of the year. The first one's going to be inflation. The second is going to be interest rates. And lastly, we're going to talk about some investment opportunities, which is going to be a quick 3 to 5 minute video. So let's talk about inflation components. Year over year, CPI remains well below the June 2020 peak of 9.1%, hovering around 3.2% since October. And despite these concerns, meaningful declines, several disinflationary forces should keep inflation on a downward path. Secondly, core goods prices trended lower in 2023 as the pandemic and geopolitical supply chain disruptions faded. Even with the Middle East crisis, supply chains are stable and goods prices should remain steady. Now, energy prices have risen a little bit, but food prices are easing. Slow global demand limits the likelihood of surges in these categories. Shelter inflation, which makes up roughly 30 to 35% of CPI, should decline as real-time measures of market rents decrease. And lastly, core services prices, excluding houses, have stalled, mainly due to the elevated transportation costs like auto insurance and repairs. As vehicle and auto repair costs decrease, pressure should ease. Moderating wage growth will also help service prices trend lower. Now, here we go. Jerome Powell, the Fed, and the interest rates. The Federal Reserve has left rates unchanged at 5.25 to 5.5% during its most recent meeting and signaled some rate cuts in 2024. However, there's been a slight reduction in the forecast. As we all know, they have kept rates higher for longer. But what does that mean? That means that the rate hikes that were in the system need to come out, which is the reason why you're seeing markets get a little bit volatile, may revalue themselves here in the short run. Now, what does this mean? Well, that means that the Fed is combating sticky inflationary prices like we just mentioned, and they're wanting to keep rates higher for longer. But no one's really considering, and people are starting to consider the fact that what if the Fed says we're going to increase rates? Well, across the globe, now you're starting to see people become more dovish, which means they're lowering their rates and they're trying to boost their economy. We're still feeling the after effects of the pandemic, and the Fed is in a wait and see mode. So we may get a rate cut later in the year. If not, I don't think it's that big of a deal. The only issue is if it becomes politicized near. And finally, we're talking about investment opportunities. The CD rates that some of these banks may be giving us may be over 5%, maybe over 4% or 3%. There's money market yields out there that are getting us 5+%. There's treasury yields out there that's getting us 5+%. But there's going to be an opportunity where we're going to have to lock in some longer dated maturities and higher yields for longer. The Fed rate hikes have made cash more attractive. Many investors are highly allocating to cash, pushing money market funds to asset levels over $6 trillion. But history shows that cash after peaks, typically you're going to see in the last let's just talk about this. In the last 6 rate hiking cycles, the U.S. aggregate bond index outperformed cash over 12-month periods following the peak in CD rates. The S&P 500 and a 60/40 portfolio stock to bonds also outperformed in most periods. While liquidity is important, holding too much cash incurs opportunity costs. Investors should allocate long-term funds to long-term assets. Following interest rate peaks, better assets than cash have always been available for capital deployment. So, with higher valuations from strong returns in 2023 and early in 2024, maintaining a well-diversified portfolio is crucial for reducing risk and achieving solid long-term income and capital gains returns. So today, just to put a button on it, we talked about inflation, we talked about CD rates, investment opportunities, and we also talked about the Fed and interest rates. So it's important to understand these three concepts because this is the most important thing. Everything else is just noise. These things are going to impact your money and what you need to do with your money. And of course, our investments in regards to your money. So thank you guys for joining us. I want you guys to make sure that you subscribe to this channel. Thank you guys for being loyal subscribers. Thank you guys for being a clients and family of our 99 Capital Group company. Stay humble, stay safe, and we will see you guys again soon.